friends, thank you for tuning in. And today we want to go further and look at more solutions or more suggestions as far as the pilot paper is concerned. Thank you for this new session that we want to look at still the pilot paper. We want to look at our last question in the pilot paper that was issued in September 2015 as far as advanced financial management is concerned. Now, in question 5, this being the last question in our pilot paper issued in September 2015, there's question 5B. The question 5B, ABC Limited's investment fund comprises of 4 major projects, details of which are as follows. We have the stock A, B, C, and D. We have the number of shares. We have the market price per share. We have the expected return. We have the standard deviation of the return. We have the correlation with the market. We have the risk-free rate of return is 5%, and the probability distribution of a market portfolio return are given as follows. We have the probability. We have the forecasted return of market. We have the variance of returns of the market portfolio is 169%. Required 1. Using portfolio theory, evaluate whether the portfolio is super efficient, efficient, or inefficient. Roman 2. Using the capital asset pricing model, advise whether management of this company should change the composition of their portfolio or not. C. State and explain N3 conceptual differences between portfolio theory and the capital asset pricing model, CAPM. Now, friends, from the required point of view, required Roman 1 is we use the portfolio theory to evaluate whether the portfolio is super efficient, efficient, or inefficient. Remember, we need to determine portfolio as a whole, not the securities, but we are looking at portfolio as a whole. How do we identify whether it's super efficient, efficient, or inefficient? We are simply going to compare the expected return of the portfolio and the required rate of return of that portfolio. We are going to use the security market line to determine the required rate of return. So simply, I have said again this, that we compare the expected return of the portfolio and the required rate of return of the portfolio. If the expected return of the portfolio is greater than the required rate of return of the portfolio, then we say it is super efficient, or in other words, we can say it's undervalued. If the expected return of the portfolio is less than the required rate of return of that portfolio, then we say it's inefficient. In other words, we say that it's overvalued. If the expected return of the portfolio is exactly equal to the required rate of return of that portfolio, then simply we say it's efficient portfolio, or rather we say is correctly valued. Fine, that's what we are going to do. Then Roman number 2, using the capital asset pricing model, advise whether management of this company should change the composition of their portfolio or not. In this one, it means that we are going to identify we are going to determine the alpha value for each security in that portfolio so that we can be able to advise. If all the securities are undervalued, then we say that's a good project, that's a good portfolio, that all the securities are good securities. But if one of the securities is undervalued or overvalued, the one that is overvalued will suggest to sell, or will suggest to not to purchase them at all. That is what we are going to do. So we'll talk about it as that time comes. Part C, we state and explain N3 conceptual differences between portfolio and capital asset pricing model. The differences between portfolio and CAPM, that's not a big problem. One of the obvious ones, you know that in a standard, in our portfolio, we measure total risk using the standard deviation. While in CAPM, we measure the systematic risk using the beta factor. We are going to come back to that and give more differences on the same. Now we start off from part B. In part B, we are given the stock, that's the securities, there are 4 of them, the number of shares, the market price per share, the expected return for each security, the standard deviation of return for each security, and the correlation with the market. Meaning they have given us the correlation between the security and the one for the market for the purpose of determining the beta factor. Then we know that we have also been given the risk-free rate of return, which is 5%. We have been given the market portfolio. We have been given the probability and the expected, or rather the forecasted return of this market. That's okay. The variance of return of the market portfolio is 169. We have been given the variance of returns of this market portfolio. Well, we are going to come back to that. Now, we come to the required Roman 1. We are saying, we are talking about the pile of paper. August, was it August really or September 2015? We are looking at question 5B. Question 5B, we have Roman 1. We use portfolio theory to evaluate whether the portfolio is super efficient, efficient, or inefficient. In that case, to determine whether the portfolio is efficient or not. Here we are going to compare. We compare the expected return and the required rate of return of the portfolio. That is determine the alpha. Then it means the alpha of the portfolio is equal to the expected return of the portfolio minus the return of the portfolio. If the alpha is greater than 0, or we say the expected return of a portfolio is greater than the return of a portfolio, then this is undervalued, or we say super efficient. Alpha value of a portfolio is less than 0, or we say the expected return of a portfolio is less than the required rate of return of a portfolio, then overvalued. Inefficient.